Welcome to the Beckonomics Podcast. I'm your host, Victor Beck, here alongside Hunter Beck, as we break down weekly market movements, macroeconomics, and what investors should be keying into as we look forward in this market environment. As a note, the topics discussed and opinions given are not intended to address the specific needs of any listener. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Clients of Beck Capital Management may maintain positions in the securities discussed in this podcast. Hey Hunter, I'm looking forward to providing our listeners today with a little market update. The things we've really been looking at, what we're looking forward to, and just overall kind of what's going on in the market right now.
Yeah, Victor, we had a big week this week and have another big week next week, so excited to get into it.
Definitely. So I think just kind of kicking off year to date, looking at just broad-based returns. S&P is already up 2.8% for the year. We're not even done with January yet. So that's, relatively solid market performance for, just to start out the year. The NASDAQ's doing even better, up about 4%. But as you can kind of see from, looking at the equal weight S&P, equal weight is exactly flat on the year. So you're still kind of getting that large cap, mega cap names driving it. I mean, I looked today, NVIDIA's literally a quarter of the market returns so far this year. So, that company starting off exactly where it left off 2023, here coming into 2024.
So really seeing those Magnificent Seven, mainly, led by NVIDIA, again, being the drivers of a year where you have a lot of analysts expecting broader market performance, broader market participation here, but starting off the year with an old tail.
Exactly. And, speaking of the Magnificent Seven, it hasn't been all magnificent for the Magnificent Seven this year. So we had a huge week of earnings this week. It was almost a quarter of the S&P market cap reported earnings this week. Another really big week for earnings next week. But the story really has been kind of coming off of our points about NVIDIA is that a lot of these AI names are the ones that we've seen have some pretty solid earnings, pretty solid announcements so far. So ASML, who is a lithography machine producer, they're somebody who's they build the equipment that helps the semiconductor companies make their chips. So the infrastructure of the chip makers. They reported really excellent earnings. We also saw Netflix, American Express report good earnings, Freeport-McMoRan report good earnings. But as I mentioned, earnings have been pretty mixed so far. So going back to that Magnificent Seven, Tesla had relatively disappointing earnings the other day. They were down about 12% off of that. And we've just kind of seen this big pullback in the whole EV market in the first place. So it's not terribly surprising. I thought that the stock price reaction to that was a little bit more than maybe it deserved to be. And then also we've seen Intel also had relatively disappointing earnings. Investors weren't super thrilled about that one either. And so, going back to some of the macro, kind of what's been going on. Hunter, you want to kind of run through, we got some GDP numbers this last week. You want to run through that for our listeners real quick and just kind of give a brief overview of, what we saw from a GDP perspective?
Yeah, exactly. So GDP came in well for Q4. It came in at 3.3%, which was above expectations. It was down off of the third quarter's 4.9%, but the markets were really only expecting about 2%. So 3.3% GDP growth in Q4, really good numbers. Great to see a strong economy, even in the midst of all this tightening. We've gotten to a point where the real tightening felt by the markets is at an all-time high. With inflation down further, that gap between the rates and where inflation's at is the largest it has been. So having a resilient economy is huge right now.
Yeah, just to make a quick note on that, I mean, it was pretty impressive. I mean, the market, the Wall Street was really expecting 2% on that GDP number. And so for that to come in over 3% really shows that economic resilience, kind of provides more fodder for that soft landing scenario that we're looking at. And I know we're going to talk about the Fed here in a little bit, but just to see the economy continue to chug along despite all this tightening that's gone on from a monetary perspective is really positive. And like we said with earnings, I think on the net, earnings have been coming in relatively positively. So between, corporate America and, Main Street, things are looking pretty good so far this year.
That they are. And GDP is not the only good economic figure we got this week. Victor, you want to tell us about the flash PMIs that came in?
Yeah, so PMIs, for our listeners, that stands for Purchasing Managers Index. And all that you really need to know about this is that it's basically tracks business activity. So the two things that they look at are manufacturing and services. So the manufacturing PMIs, and the way that they gauge this is 50 is basically baseline. So if you're above 50 on the PMI scale, business activity is expanding. If you're below 50, it's contracting. So what we've seen recently, especially on the manufacturing side, is numbers below 50. So that portion of the economy, manufacturing, has been contracting pretty much for the most part over this last year. Well, we just saw that manufacturing PMI go back above 50, which is really positive from an economic perspective, an economic standpoint, that manufacturing activity is expanding. That's healthy for the economy, good for the people that employs. And we also saw services PMIs over 50 as well. They've been in that territory for quite some time, but they actually increased. So that went from 51.4 in December to 52.9. So just showing that, you're further into expansionary territory for those services PMIs. And just as we continue to say, it really bodes well for the economy and shows that things are looking good for where we stand.
Yeah, and a great thing that we saw with this is that despite the growth in both manufacturing and services, the prices paid, the inflationary point of all of this, did not increase along with it. So we're seeing economic growth without that inflation that everybody's so worried to see.
Yep, exactly. And so, continuing on with this, kind of our macro data, we also got a really important inflation figure. I know you and I talked about, CPIs that came out earlier this month, but can you talk about PCE inflation and give our listeners a quick reminder of what that is, why it's important?
Yeah, Victor. So PCE is the Fed's preferred inflation measure. It's personal consumption expenditures. It's similar to the CPI in a lot of ways, but it allows for substitutions, whereas the CPI is based on a fixed basket of goods. PCE better models the kind of consumer experience where if breakfast cereal is a little expensive, maybe you buy something else, some oatmeal or something. So it allows those substitutions that consumers make almost passively as prices increase and there are cheaper options out there.
Yeah, it really shows what people are actually spending their money on. CPI, you're not going to be buying all those goods on a monthly or even sometimes yearly basis. But PCE is just a better model of what people are actually spending their money on.
Yeah, and so that's why it's so important to the Fed. So that came in at 2.9% in December, which is the first time it's been below 3% since all of this inflation kicked off. Which the markets were expecting about 3, and having that 2 handle on there is going to be a big deal for the Fed. I think it was our Q3 newsletter that I was writing about housing inflation specifically. And I said, as soon as we get a 2 handle, the Fed will be able to declare victory. Well, I think we're finally there. And even though we're not expecting a rate cut at this next FOMC meeting, as Victor will talk about in a little bit, I think it really gives the Fed a lot of flexibility to operate there. So a couple of things I want to call out with a PCE. We don't get as much detail as the CPI gives us, but services as a whole moderated down to 3.9% year over year. And that's the same thing we're watching in the CPI, is that really it's that housing, the shelter component of services that's keeping that elevated. And then durable goods extended further into deflationary territory. They're now down 2.3% year over year. True deflation, getting cheaper, which we, after all this inflation, Victor, I think we have a little bit of room to give back on this. But at the same time, deflation's not healthy for an economy.
Yeah, we've been talking about this, for a while, is that inflation, whenever you've got, healthy inflation in the market, that's going to drive everything from your top line to your bottom line when it comes to earnings, which is a certain level of it is healthy over a period of time. You keep expanding the money that's flowing around the economy, and that's good for those corporations from an earnings perspective. Now, you and I, from an investment standpoint, we're really keeping an eye on those goods, being in that deflationary territory, because if that comes to corporate pricing, then that's going to trickle through to their top line. So if your revenue is lower because you can't charge as much for those goods anymore, that can impact your earnings. So it's definitely something that we're watching.
It really is. It's a big deal for all these corporations, and for a whole multitude of reasons. And that kind of leads us into our view on the Fed right now, is that we think that a rate cut sooner rather than later would be beneficial for the markets, for the economy as a whole. I don't want to just say the markets because it's really about the broader economy. Because what a interest rate cut would do, even 25 basis points in March, is what I'm hoping for personally. Because even that 25 basis points, that's not going to be material from where we're at, but it'll, on the margins, relieve some of the pressure that we've seen in the housing market, keeping those existing homes off the market, allowing those volumes to pick up a little bit as that 30-year mortgage comes down, as well as take the boot off of goods prices, because we've seen them continue to deflate, and now they're deflating more than they have been. They're at down 2.1% in November. So now 2.3%. Well, we don't want to see that continue to get worse. So I think, that 25 basis point cut just allows a little bit more breathing room in the economy for these prices to kind of moderate.
Yeah, I think you're exactly right. As you mentioned earlier, I think it's okay that these goods have come back in a little bit, because we saw really substantial inflation between the end of 2022 and throughout 2023. So a little bit of that is healthy, and it's going to be good for the consumer in the long run. But we don't want to see that for an extended amount of time. And so you just mentioned the Fed. So, quickly before we kind of dive into, we've got an FOMC meeting, Federal Open Market Committee meeting next week. I want to talk about what we're looking forward to next week, and I want you to give us a little bit more in-depth on kind of what's going on with Fed and with that meeting. So next week is going to be the biggest week for earnings for the S&P 500. We have got some massive names that are reporting next week. AMD, Google, Microsoft, Apple, Amazon, Meta, ExxonMobil. And then one of our favorite companies we've been watching lately, a smaller one, but a super microcomputer, following that AI trend. I think those are going to be some really interesting earnings, along with a huge slate of other ones. Boeing's in there. There's been a lot of news around that company lately. So really going to be an interesting week to see what we hear from those CEOs. We expect that earnings slate to be relatively positive, but that's why we're analysts, why we're here to watch and and listen to what they have to say. We also have a jobs report for the month of January next week. So the jobs report is always the first macro data point from the most recent month. So we flip into February next week. We get that latest jobs report for January. So it's going to be good to see. Obviously, the Fed is keen on watching that unemployment figure, whether or not that's going to tick up because of all this tightening that's flowed through to the economy or not. Something that we'll be watching. And then, of course, the Fed meets next week. We don't expect any action from them. But Hunter, you want to talk a little bit more about that? What are we looking at? What do we kind of expect from them?
Yeah, so the Fed meeting this coming week is going to be important from a number of angles. Like we've mentioned a couple of times, we're not expecting a rate cut, and neither is the market. While I would welcome one, it's just too early for the Fed. From their point of view, the Fed probably just doesn't want to do that quite yet. We are, however, expecting them to reduce the rate of QT, or quantitative tightening. So what's happening right now is that the Fed holds a lot of bonds and similar fixed income assets on its balance sheet that it accumulated after 2008 as part of monetary stimulus, and then again during COVID, kind of injecting some more capital into the markets. Well, currently they're letting a lot of those bonds roll off and only repurchasing a small portion of that. We're expecting them to reduce the rate at which they let bonds roll off. It will still be quantitative tightening. However, it'll be at a reduced rate, but we're expecting about a 50% reduction in that bond roll off.
Yeah, exactly, Hunter. It's going to be interesting to see what they do with that quantitative tightening agenda. And for our listeners, the reason this is important is because whenever the Fed's letting these bonds roll off their balance sheet and they're not repurchasing them, that's just taking dollars out of the economy. So, whenever they do repurchase a portion of those bonds, that's money that flows back in, whereas right now this is just rolling off of that balance sheet. Currently, they've capped Treasury roll-off at $60 billion a month. We're kind of looking for that to maybe go to $30 billion, whether they make that decision at this FOMC meeting or the one in March. I think it's going to be interesting to see. There's definitely going to be more commentary around the quantitative tightening agenda, which not a lot of people have talked about. And honestly, the Fed hasn't really talked a whole lot about it. You usually get maybe one, maybe two questions from reporters whenever Jerome Powell gives his press conference about quantitative tightening, but it hasn't really been in the spotlight, but it's definitely acting behind the scenes. So kind of looking for that cap maybe to go from 60 billion of treasuries per month to 30 billion. They also hold mortgage-backed securities as a large portion of their balance sheet. From what I've read, from most analysts across the street, don't really expect that to change, but they're currently capped at 35 billion a month of MBS on top of that 60 billion of treasuries. So we'll have to see if that happens to change too.
Yeah, so what you're telling us is probably closer to about a 1/3 reduction. Exactly. Once we include those MBSs.
Exactly. Well, Hunter, I think we did a pretty good rundown of kind of what's going on in the markets right now. Lots of macro data, micro data with all those earnings that I mentioned. It's a pretty exciting time to be an equity analyst, to watch what's going on with the markets, and I'm excited to see how things unfold in the coming week.
Agreed. I think next week's gonna be a lot of fun, a lot of work looking at all these earnings reports, but it's gonna pick back up and be really interesting stuff.
Yeah, Hunter. Well, thanks for your insights, and everyone listening. Thank you for tuning in to another episode of the Beckonomics podcast.